Welcome to the XUCPA channel. If you are a business owner and you own an LLC or a corporation, you most likely have a March 15 or April 15 filing deadline. Over the years, we have seen so many mistakes made by business owners when they submit their own filings. Today, we want to share with you what are the common mistakes and how you can avoid these mistakes. So please stay tuned. The first common mistake I want to talk to you about is filing wrong form because you do not understand your entity structure and your filing requirements. An LLC could file a Schedule C, a C corporation tax return, an S corporation tax return if you have S election, a partnership tax return if you have different managing partners in the LLC. Most business owners who have an LLC do not know what type of tax return they should submit to the IRS. For example, I've seen people with S election who actually submit a C corporation tax return. People with an S election actually submit a Schedule C as a sole proprietor and disclose it on their 1040. So how do you avoid these mistakes? The lesson is do not file your own taxes if you run a business. Point number 2, file without review. It is common that people hire a CPA, submit the information, and then sign the tax return without any discussion with your CPA. All the numbers in your tax return just don't look familiar to you. You do not understand any loan balances shown on your tax return, and you are not aware of any payroll liabilities that are shown on your balance sheet. Bottom line, you don't understand what you are filing to the IRS. And this is something that you definitely need to avoid because you need to understand what you're filing. So want to avoid any of these mistakes, speak with your CPA. Common error number 3, assets recorded without depreciation. This is a real story. I was performing a tax diagnostic for this business owner. He had purchased a business with goodwill of $600K, which under normal circumstances should have been amortized. Instead, this $600K was recorded under other assets with no amortization, which means no deductions for many years. As a result, we had to amend all this tax return to claim a refund for the business owner. Now, you definitely want to avoid these mistakes because anytime when you amend a tax return, you could increase IRS audit risk. Common error number 4, negative balances. Negative balances often indicate possible errors on your financial statements. If your QuickBooks is showing negative bank balance, you may have duplicated your expenses. If your QuickBooks is showing negative credit card balance, it indicates overpayment of your credit card, which is not typical because you would never overpay in your credit card balances. That could mean that you're missing some credit card transactions, losing tax benefits, resulting in paying more taxes. Want to avoid these mistakes? Do not try to balance your own books. Common error number 5, loan to shareholder. This is a high audit risk area because IRS could just recharacterize this loan as taxable income such as wages or dividend. So anytime you see a loan to shareholder balance on your Schedule L or your balance sheet on your tax return, you need to understand why. To sum up, if you are reviewing your business tax return, the following should be considered. 1, are you using the right form? 2, have you reviewed your financial statements and tax return with your CPA? 3, have you taken depreciation on assets purchased during the year? 4, are you missing any expenses? 5, is there a loan balance on your tax return that you are not aware of? If you're confused, I can understand why. This is a lot to chew in one video. Please reach out. We would love to help you with any questions you have. As usual, we put in so much effort in this video, so if you could please like, share, subscribe, and hit the bell notification, we would appreciate it very much. Thank you so much for watching. I will see you next time.